Hello financial fans, welcome back to another stock analysis. Today we'll be covering Medical Properties Trust, stock ticker MPW. Medical Properties Trust, or MPT, is a real estate investment trust that focuses on owning and investing in healthcare facilities such as hospitals, medical office buildings, and other healthcare related properties. MPT's primary business model involves owning and leasing properties to healthcare providers, generating rental income through long-term leases. MPT's strategy is to invest in properties that are critical to the delivery of healthcare services and are typically leased to established healthcare operators including hospital operators, healthcare systems, and physician groups. By investing in healthcare facilities, MPT seeks to generate stable and predictable income streams for its investors while also supporting the delivery of critical healthcare services. In addition, MPT aims to help healthcare providers and systems access the capital they need to expand and improve their facilities and services. MPT's business model has several benefits for investors. Firstly, healthcare facilities tend to be stable and long-term tenants, which can provide steady stream of rental income. Additionally, MPT's properties are often located in high-demand areas, which can help to drive occupancy rate and rental rates. Keep in mind though, MPT's stock price has severely declined due to some of their tenants facing financial challenges, so just keep this in mind for the final valuation. The company is currently sitting at a $4.5 billion market cap, and in 2022 they generated a revenue of $1.5 billion, and the dividend yield is currently sitting at a very high 15.41%. 58% of their revenue comes from United States, 22% from the United Kingdom, 6% from Germany, 6% from Switzerland, 5% from Australia, 1% from Spain, and the remaining 2% from various other countries. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25%. That can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from margin of safety. First two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from $75 million in 2013 to $731 million in 2022. The average EBIT growth is almost 54%, meaning a 10% deduction in the margin of safety. The margin has also gone significantly up over the past years, going from 37% in 2013 to 62% in 2022. The average margin growth is almost 26%, meaning a 5% deduction from margin of safety. The next two ratios that we'll be looking at are the dividend growth and the debt to EBITDA ratio. The dividends have gone up over the years, going from 80 cents a share in 2011 to $1.16 a share in 2022. It says 2021, but it's supposed to be 2022. The average dividend growth during this period was 3.8% on average, which is no change in the margin of safety. The debt to EBITDA ratio is sitting at 754%, which is really high. To get a debt to EBITDA ratio, you have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this we get the amount of years of EBITDA it takes for the company to pay off all of their debt, and as you can see on this ratio, it's over 7.5 years, which is considered incredibly high, so a 5% increase in the margin of safety. The final two metrics that we'll be using is the occupancy rate and the rent reversion. Occupancy rate is the amount of property that they own that is currently occupied and being rented out. For Medical Properties Trust, this is 99%, which is considered very good. So a 5% deduction in a margin of safety. The rent reversion rate is when a landlord raises the rent on a property when a lease is up for renewal to match current market rates. Basically saying, are they making more rent out of their property every single year? In this case, they're actually not. The rent that they're getting from their property has declined by around 5.3% every year on average, which is a 5% increase in the margin of safety on this metric. Let's look at the valuation models next to determine the intrinsic value of Medical Properties Trust. The first valuation model that we'll be using is the price to funds from operation. I've imported the share price of MPW of the past 10 years, as well as the funds from operation per share of the past 10 years as well. And we got an average price to funds from operations during this period of $14.10. Doing the same for the trailing 12 months, we get a price to funds from operation of $4.25. This gives us an intrinsic value of this model of $24.95. which is a 231.34% upside because of this massive deviation from the trailing 12 month to the average price to funds from operation. The second model that we'll be using is the dividend discount model, and we report the dividend payouts of MPW going from 2018 to 2022. And the average growth rate in the dividends during this period was 3.78% on average, and I'm projecting an expected growth rate in their future dividends of 1%, and we'll be using a discount rate of 9% in this valuation, and then we get an intrinsic value out of this model of $14.65, which is a 94.5% upside out of this model. And the last model that we'll be using is adjusted funds from operation multiple valuation. This model will be looking at similar companies to MPW and look at their price to AFFO multiples. And on average, in the industry, this is sitting at 10.23. And doing the same for MPW, we get a price to adjusted funds from operation of 9.86. And this gives us an intrinsic value of this model of $7.82, which is a 3.79% upside out of this model. If you want access to all of the valuation models that I use in my videos and way more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of a valuation next. Looking at a final overview, we've imported the intrinsic value out of the price to FFO model, the discounted dividend model, and the AFFO multiples model, which gives us an average of $15.80. A margin of safety we've determined earlier using a standard margin of safety of 25%, deducting it by 10% for the EBIT growth, 5% for the margin growth, adding 5% for the debt to EBITDA, deducting another 5% for the occupancy rate, and adding another 5% for the rent reversion, giving us a margin of safety of 15%. Applying this margin of safety, we get a fair value of $13.74, and with the current price of $7.53, we get a massive upside of 82.5%, indicating that's currently a buy. Keep in mind though, this business has some severe risks attached to it, and that's why the share price has been dropping so much lately. If there are any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.